Hello everyone. It is Tuesday, February 23rd, 2021. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most influential charts and data series and models that we are focusing on this week. Number 1, market internals. For our market internals, we use our own in-house model called the Asbury 6, and that is currently positive. You can see the Asbury 6 here. The Asbury 6 is a combination of 6 different metrics that we have back-tested with each other because they work well together. What does that mean? It means every index, or every indicator rather, that we work with has an Achilles heel. Nothing works all the time. So these 6 tend to work very well with each other. In other words, when one is giving a signal to sell, the other 5 might pick it up and give you a buy signal. Only one of these has to do with price, which is the rate of change here up top in the S&P 500. All the other 5 are what I would call secondary indicators: corporate bond spreads, volume, breadth, things that measure the internal strength of the market so you don't get faked out by all of the day-to-day volatility that we see now in the major indexes. And you can see, except for one, which is trading volume, the other 5 have been positive as of the very beginning of this month. 4 or more metrics in one direction indicate a tactical bias, which we have. And when all 6 are positive, market internals are the most conducive to adding risk to portfolios. So this is what we look at first. What's the condition of the market? It's like going to the doctor. The doctor has those 5 or 6 things that he does when you first walk in. He takes your blood pressure. He takes your pulse. He may listen to your heart and lungs. He may take a little bit of blood. That's what the Asbury 6 is for the market. We update this every day, and right now everything is green or positive. The next thing we do is try to see what the trend looks like, where the support is. Right now, as of this morning, the S&P 500 is testing its November tactical advance. What do we mean by tactical advance? We mean it's testing its 50-day moving average. You can see it's at 37.96 here as of this morning, and we came right down and tested it pretty close to the opening, and just as it's been in the past, as it happened just in the end of January, it's like Pavlov's dog. The bell rings, buy the dip, everybody runs in. We have been trained to do this as investors. The Fed has come out and effectively said that they will not let asset prices decline. So when we come into these support levels, that the buy the dip mentality clicks in, and it's kind of everyone back in the pool. So that's what we're seeing this morning. Came down, we tested the support around 3,800, and now we're coming back. If this uptrend, tactical uptrend, is still intact, this is exactly what should happen. It should test it, and we should make new highs within the next couple of weeks. That's been the pattern. Number 3, sector asset flows. Financials and energy are driving the advance. The next thing that we do is use another one of our in-house models called the CEF model, which is the sector ETF asset flows model. And what this does is measures the percentage of assets moving in and out of the 11 sector spiders. And what we do in this model is in 3 different time frames: trading, which is 5 days, tactical, which is 21 days, and strategic, which is 63 days. We highlight the 2 biggest percentage assets in and the 2 biggest percentage assets out. So what this is showing you, energy has been all the way across in 3 different time frames. It's been one of the top 2 percentage assets in. It also shows you in the financial sector 2 of the 3 time frames. biggest percentage asset flows in, and the red cells show you the percentage of assets out. So cutting to the chase here, this model has showed a continued trend of inflows going into financials and energy since 11/12, November the 12th. This is where the money is going and has been going in the sector space for the past 3 months. Not by accident, these have been the two best performing sectors over the past 3-month period. Energy is up by 41.3% or 20 and has outperformed the S&P 500 by 27.9%. That is XLE. And financials, or XLF, has risen since November the 12th by 21.9%, has outperformed the S&P 500 by 10.4%. So these two leaders have been leading, and that's been a major driver along with technology in getting the S&P 500 up to new all-time highs so far this year. The outflows are coming from consumer staples since November the 25th and healthcare since 12/4. So we avoid those two sectors. Number 4, ETF asset flows indicate the other leader, tech, and that's usually the traditional leader. Is during a strong, healthy, broad market uptrend, tech is leading. Well, right now it's sputtering. Let's have a look at that. We have the NDX up here, which is NASDAQ 100, and then we have the total net assets that are invested in the Qs, the QQQ. Down here, along with its 21-day moving average. Why the 21-day? Because that's Asbury Research's tactical time period. And what you can see here is this been in a trend of monthly expansion, tactical expansion of assets above the 21 days since November the 5th. But as of yesterday, we lost that trend. It looks like we may be beginning a new trend of monthly contraction. If we could snap back here today, we may dodge a bullet, just like we did on January the 29th. However, if those assets continue to flow out of the Qs, that indicates to me that we have lost some of our leadership, maybe our most important leadership being tech. And then finally, number 5, we look at relative performance of tech now. I want to see if these assets coming out of the Qs is showing itself in how tech or how NDX is performing versus the S&P 500. And look what we have here. Basically, since November the 30th, the Qs have been outperforming SPY. The Qs represents the NDX, SPY represents the S&P 500, of course. We had a trend of strategic outperformance, which is 63 days for us as our strategic time frame. Strategic outperformance since November the 30th, we lost that as of this morning. You can see we dove underneath that 63-day moving average. And we also broke the 50-day moving average here in the Qs. So it looks like we've lost tech, unless we can see a tremendous spike back up higher in technology over the next day or two. It looks like we've lost tech as leadership. What does that mean? It means that now we're leaning even harder on financials and energy to hold the entire market up. It's going to make it a lot harder for the market to move higher. So our focus this week is really on technology. Technology needs to recover here, and if it does not, it could be the first indication that we are going into an overdue corrective decline between now and the end of the quarter. So that's your Daily 5 for today. Thanks for watching.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.